Hi there, this is Christian Dye from Latitude West Financial. It is October 2023, and we're doing our quarterly report to tell you what's going on in the real estate and the stock market and the prediction of what's going to happen in the future. I'm joined by Dara Fahy from Citywide Mortgages and Ryan Runke from Stonehouse Realty. So I thought we would jump right into it by first saying that today our information is not to promote the buying or not buying of any real estate or any stocks. We advise that you do the research on your own, work with your trusted advisors. Today is just for educational purposes only. So we're going to start with the question, what is the real estate market outlook for 2023, 2024? And we're going to start, of course, with our local market here in BC. So Vancouver housing prices continue to be high, of course. There was a 13.2% increase in sales in September of last month compared to September of 1 year ago. So there is an increase in sales. But this is a 26.3% below the 10-year seasonal average, though. So we're still not quite having as much sales as used to. The average residential property in Metro Vancouver is 1.2 million. This represents a 4.4% increase over September of 2022, but a 0.4% decrease from the summer of 2023. So we take a look at the cross section of detached, townhouse, and apartment. One thing to remember, this is Metro Vancouver, so we're including all of our, of course, surrounding suburbs. So prices, of course, are still incredibly high. There has been a minor correction, but nothing major. What we want to do is we want to take a look at what this means for sales to active listings. So just to remind people, whenever sales to active listings drops below 12%, we consider it to be a buyer's market. When it's above 20%, it tends to be a seller's market. So right now, if we take a look at the trends, they've often been well above 20%, which is why we've had, of course, buyers struggling to find things, to also victim to bidding wars and things of that sort. However, if you take a look at the story now in summer compared to September, we are now in that range of being in a bit more of a balanced market. Detached homes at 12.6% even. So the one thing I kind of remind you is we might be in a little bit more of a balanced market, but at the same time, we want to, all of our information is usually a couple of weeks old. And that's why we bring in Ryan and Dara to tell us really what's happening, because their information is much more current. So according to the numbers, Ryan, we are in a balanced market. But, you know, what we'd like to do is hear from your perspective. Rental rates are, of course, on a massive rise. A little demographic shows how much it's gone up year over year. Vancouver is leading the way with the highest increase in rents based off of a 1-bed and a 2-bed condo. So it's going to be pretty, it's good for the investor if you already have it, but what we are going to find is if you're a renter, you're probably feeling the pinch and the pain right now. So what we want to do, let's see here. We want to take a look at what's happening now in real estate. So Ryan, help lead the way over here. What are you seeing with your buyers and your sellers?
Yeah, afternoon. Happy Thanksgiving. It's actually slower. I mean, I would say overall, maybe it's a balanced market, but it's definitely slower. We have listings kind of everywhere right now: Coquitlam, Richmond, Vancouver, Burnaby, and the rates have definitely had an impact on it. There were a lot of people in the summer that had the lower rates on hold. Derek can probably attest to that. And now that those are expiring and they're having to qualify for the higher interest rates, that's definitely having an impact. So I think it's pushed some of the buyers out of the market right now. But on the other side, there still isn't enough inventory in general. So stuff is still selling, but instead of, selling in 2 weeks and the multiple offers and stuff that we had, we're looking at like a couple months, I think now. So people have to, I think sellers kind of have to shift their expectations that stuff's going to take a little bit longer to sell. It's not necessarily multiple offers and, going to sell right away. And for buyers, I would say there's some deals out there. I mean, depending on the seller situation, we have some higher price listings. There's definitely more room to invest in now than before, or room to
Sure.
negotiate.
Yeah, I mean, so when things are priced correctly, are you finding that it's people are going in with an asking, or it's like a 95% of asking, 90% of asking?
Yeah, we're staying a little bit lower now. I would say people are trying to get more off now, so probably within a 5 or 10% off depending on the product. Whereas of course before you're getting asking or a lot of times over asking with the multiple offers. So now with the rates being higher, there's just a less there's less buyer pool all around. So yeah, they're definitely seeing discounts that you weren't seeing a few months back.
What areas do you sort of find that you feel might be a pretty good bargain right now? Is it the Fraser Valley? Is it Metro Vancouver,
Yeah,
North Shore?
yeah, a couple of things. I think Fraser Valley is still good. Like Langley, I've still been pushing that for a while because the SkyTrain is going to go out there. There's a lot of product out there, so there's some good deals. And then Vancouver just actually approved the multiplex. So now, if you have a 6,000 square foot lot, you can build up to 6 units, and a standard lot you can actually do 4 units. So on the investor side, there might be some good opportunities to buy an older house, like a tear down house in Vancouver, and then start to hold that and look at selling it to a developer. Um, and the other thing we're kind of pushing a little bit is, I don't love pre-sales, but there's some good opportunity with pre-sales. A lot of them have lowered their prices quite a bit, and there's lots of projects in the Okanagan. We sold one in Penticton, Solcana. I know that you're familiar with it. Really good returns for rentals and Airbnbs and stuff that are fully allowed. So some of those might be a good investment now because you're just putting in your deposit and you're not having to worry about the rest of the funds for a couple of years. Whereas right now for cash flow and stuff for Vancouver, it's difficult, right? Even though the rents have gone up quite a bit because the interest rates are so high, it's harder to get cash flow.
Got it. Got it. Yeah, I remember that's what we're looking at as well for our investor clients is anything that will cash flow. And usually it's a short-term rental, such as an Airbnb, something of that sort. And of course, we're looking outside of province as well. But inside province, I know that Penticton project that you were talking about, the numbers did seem to work for phase one. I'm not sure what phase two is going for now, but no, that's good. Ryan, what about future outlook? What do you think the housing price is going to do in Q4 and Q1 of next year?
Yeah, it's really tough to say. I think if the rates still remain high, we might see a little bit of a dip. But I think the other side of it, once the rates do come down, the market is probably going to trend up pretty quickly. So I think these next 4 or 5 months, we might see a little bit of a dip overall in prices, but I think that'll be short-lived. I think once the rates start to come down, you have so many people on the sidelines that are ready to jump in. They just can't qualify for what they used to be able to. And because rents are so high, it doesn't make sense for a lot of people to rent and pay these crazy amounts when they, will be able to afford to buy again down the road.
I
So
think
I would say a little bit
yeah.
of a decrease. Yeah, a little bit of a decrease, but then after the rates drop, hopefully by the end of next year, then we'll probably see it go up pretty quick.
Yeah, I've seen that so many times, as have you, where we suddenly hit a high market, like a seller's market, and then we go into a balanced market, and then there's a tipping point where something as simple as the rates going down by a half a point, and then all of a sudden there's a spike up, and then when people start to realize that I can sell my house now, then you suddenly get a lot of people making movements, and all those movements cause there to be a lot more price increases.
Yeah,
So
exactly.
I would say that timing the market is a very, very dangerous thing to do. If you need to buy, I would say find something you could afford and just buy it.
Yeah.
But trying to wait for it to go down, like we advertise this as saying, is the bubble going to burst? From the data that I've analyzed, I don't see any sign of that because of supply, the lack of supply. Because of the lack of supply, I can't see there being a 20%, 30% correction where suddenly $1 million townhouse is now worth 700,000. I don't see it. There are going to be so many people that just end up buying it once it hits the 900,000 mark, just because they'll know they're getting a significant discount on a good product that has a lack of supply. Like the only way our market can ever burst is if suddenly people didn't want to live here anymore. And I think
Yeah.
that's people literally leaving, saying, "Hey, I'm going to pick up and move," and people coming in are saying, "Hey, I'm not going to come to Vancouver anymore." And this would have to be in incredibly large numbers. But even an increase of interest rates at 8%, 9%, 10%, I don't think that'll cause us to burst, especially because I read a statistic the other day with it. The majority of like there is a large number of residents in the Lower Mainland that have no mortgage. So the interest rates aren't going to affect them at all. And so it is kind of the people who are most affected is that kind of the person who's had their mortgage for less than 5 years. Of course, those are the guys going to be affected a lot.
Yeah, and then you have to account for immigration too. I mean, there's so much new immigration happening over the next couple of years, and there really isn't enough housing for those people as well. So obviously they're not buying multi-million-dollar homes, but you still have to put them somewhere, right? So that's why like the cities are now doing more options like Vancouver with the multiplexes and stuff. So yeah, I don't think there's going to be a drastic reduction overall, but it's going to be interesting next couple of months.
Yeah, absolutely. So what I want to do is I want to shift gears a little bit, Ryan, to Dara with his point of view on the mortgages and what is going on. So Dara, are you there?
I am here. Yes. Thanks for having me.
Yeah, no problem. So I know that the bank, since we last spoke last quarter, the prime rate has gone up. And when we last spoke, we were at about a 5.5 for a 5-year six and a 6.1 at a variable rate. We're in a very different environment now. Do you want to speak to that a little bit?
Yes. Things have escalated again. So we did have one quarter point increase to the variable rate since we last updated everyone, and then in September we saw no change. So the Bank of Canada did not make a change. That felt like a bit of a win. But the data coming out right now is very conflicting, and I think the reality is we are seeing bond yields which control the fixed rates go up constantly. They've probably risen about 0.5% in the last 3 weeks. That is generally a leading indicator of where things are going. So I think there is a pretty decent chance that we can expect at least one or maybe two more quarter percent increases, possibly before the end of the year. A lot of people, when the Bank of Canada held in September, thought that maybe that was a pivotal moment and a sign that we'd reach the top. But unfortunately, I don't know if that's going to be the case. It could be, and I'm not saying it won't. As I said, the data is conflicting. There's some cracks in the economy, specifically globally, that are making things look a little weak and would support them leaving it alone for a while. But then we have so many signs in our own economy that things are very strong. Everybody that wants a job right now can have one. We have almost no unemployment. Inflation is still very high. We can all feel when we go to the grocery store and we go out to eat. So I'm not sure what happens next. But if I'm guiding clients, I'm making sure that they can tolerate potentially 1 to 2 more increases, because we could see that, and very possible we stay here for the better part of 12 months. Originally, economists had predicted some rate cuts by the end of this year or early 2024. Becoming abundantly clear that is not going to happen. I think we're going to probably stay up here a little bit longer than that, and maybe hope for some relief towards the end of next year.
Got it. So that was going to be my next question. You're saying there could be anywhere between 0 and 2 rate hikes in the next four months, but you're saying there's probably a 0% chance that we're actually going to go down in rate cuts.
In the next 6 to 8 months, I would say for sure. I think realistically, if I had to guess, I think it takes 12 months before we start to see some rate cuts. And that's, again, something we have to monitor, because the data is changing constantly and things are pivoting. I mean, we're seeing in the last few days some more war in the world, which is not good, and can have a negative effect on supply chains and things like that. So yeah, I mean, we'll continue to monitor it, but at the moment, our best guess is we start to see some decreases towards the end of 2024. The U.S. Fed has suggested that they will look to cut rates by 0.5% by the end of next year. And, good chance we follow suit. So I think that's a reasonable expectation. But as mentioned, you really got to be prepared to pivot and analyze things as they come out, information as it comes out.
Got it. Got it. No, that's fantastic. That's fantastic. As I've always recommended, if you are in thinking of buying, you should really get pre-qualified, just because the rates move pretty quickly. And if you're pre-qualified and the rates go down, you get the lower rate. And if they go up, you get the lower rate. So you're always going to be ahead by getting pre-qualified. And I would sort of say if you're in 3 to 6 months of potentially buying a place. Yeah, but it sounds like the rates aren't going anywhere except for potentially up. So sometimes you just got to hold on for dear life if you are in that variable range. But if you're in a fixed, but your fix is coming up soon, I would start to, get your ducks in a row, potentially reach out to Dara, see what your options are. So for those people who are potentially thinking of buying, I remind you that our financial practice looks at cash flowing real estate in different areas. So this is a fee for service that we've added on. And just to give you some ideas of some of the places that we have found in our last report, which was last month, there's still, believe it or not, places that are under $200,000 that are in good areas outside of BC, of course, but we do find that they're able to cash flow. Whenever we talk with a client, we go through our assumptions, which includes management fee, vacancy, and also capital appreciation. The interest rate, we want to be quite conservative, so we'll usually project like a 6 or 6.5%. And then we find places that are under market value. We work with a lot of investor real estate teams across Canada and even the US. And what they do is they show us places that they know that, it'll take $20,000, $30,000 of renovations, but it's already being under market value for, $75,000, $100,000, places like that. Then we have multi-units, which are a little bit more complex, but sometimes could be easier to even get mortgages for, just because they're looking a little bit more at the property and not so much at yourself. And then a lot of these times, these prices kind of blow people away, because $785 in Vancouver is maybe a 1 or 2 bed, but in other areas, these are cash flowing, multiple units. And so if anyone was thinking of shifting some of their money towards investing, we of course invite you to chat with us so that we can discuss it further. So what I want to do now is I want to talk about what is going on and the prediction for the stock market. So for 2024. So what we do is we have our own team independently analyze the markets, but we also will view and analyze reports that we come across as well. So the S&P 500 did start to correct, and we saw some signs of life, but it failed to break 4,600. The negative year-over-year change in oil prices, unfortunately, is a headwind for the S&P 500. So that's usually not a good sign. Now, there was a Schiller report that suggests that we are heading downward. The report believes that we're going to go below 3,000 for the S&P 500. So this isn't good news at all. And their prediction should land around the high 2000s in the next coming year. I like this report because it signals that we are still heading for a recession. And in almost every report we've come across says we're in recession and we're still going to remain in recession. And then there are different signals that point to recession. And in this chart, it shows what would show a low risk of recession, which is green, a medium risk of recession, which is orange, and a high risk of recession, which is red. And if we'll notice, the reds and the orange are dominating all of the signals. So I would say, and I would agree, that we are likely the stock market in general is going to be volatile. It's going to not probably yield any type of those good market returns that anyone is hoping for. But dollar cost averaging strategy is about that. It's about not pulling out when times are bad. It's about staying in. So you want to stick to a strategy and not veer from it. But it'll still be, according to our data, still a bumpy road. So what to buy in a market correction? Well, according to our data, you want companies with very little debt but still has growth. Healthcare, utilities, and consumer staples are usually what people will buy in a market correction because, of course, they tend to be less volatile than things like tech and other sectors. Now, with our clients, if you're not investing with us, we also like the privates. So private investments, of course, you have to work through a private dealer. They're not public, which means you cannot buy any of these on your own. This is just one sample of the funds that we've got our clients in, as well as I myself invest in this. It's just more stable. It has good returns, and we have not seen anywhere close to the volatility that we've seen in the stock market. So we would take a portion of a portfolio and put it here just to stabilize, because we don't want to give up returns, but we do want to minimize volatility. So if you're not investing with us and you want to explore some of the funds that we're putting our clients in on the private side, then you want to reach out to us as well. So having said that, now would be a great time to field any questions that anyone might have between myself, Ryan, or Dara. You could put it in the chat, and I will help to moderate this. If you're listening to the recording, you could feel free to fire us an email individually, and then we could help to field that. So if you have a question, by all means, put it in the chat now, and I will moderate it. But I have a question for Dara. Dara, are you there?
I am here, yes.
Dara, as you know, I was getting your help on some commercial property in terms of rates, and right now the 5-year fixed rate is above 6%, but the commercial property that we were discussing was able to get a rate below 6% at 5.37. And I'm just wondering, well, why is there a differential there? Is that common, or did I just get like a smoking good rate over here? How come on commercial I was able to get a much lower rate than what's being offered on the residential side?
You know what, actually, Christian, that's less to do with the fact that it's commercial and more to do with the fact that it's CMHC insured.
Got it.
So for those that are not familiar with that term, a CMHC mortgage is a mortgage that is insured, where the bank receives a policy that in the event the borrower doesn't pay, the government is backing them and covering their losses. So we, as the borrowers in that situation, pay the premium, but because it makes the overall risk lower for the bank, they are able to offer better pricing and better rates. So on these, going back to the slide of mine that you showed as an example, right now, if you want a 5-year fixed, you're at about 6.25. That's a conventional rate with no CMHC insurance. For those wanting CMHC insurance, possible we could get something in the mid fives, but there is a cost to that. So, again, another reason to talk to a mortgage professional and see what's the best fit.
Got it. Yeah, and so what I'm finding is that for investors, certain investors such as myself, and some of my other clients, we're actually much better off. We're getting better deals going commercial than we are going just residential. Like, in other words, trying to buy a 6-plex or an 8-plex or a 12 unit or a 20 unit. And because the prices are, 2 million, under 2 million even, we're finding it's a bit more bang for our buck. Because we're getting slightly better rates, but we're also getting better conditions in terms of amortization, even in terms of down payment. So my mind was kind of blown when I realized that I could actually put less than 20% down payment, get a better mortgage rate, and get a better amortization period, which is why I think people should think about essentially multi-unit investing outside of province, as opposed to just staying locally, for those who are there.
Christian, you do make a good point. I will say this, on top of the CMHC insurance providing better rates, I do believe you have a little more leverage to get a better rate on a commercial or multi-unit property right now. I don't know why that is. I couldn't explain it other than perhaps the bank just has more of an appetite for that kind of stuff right now, and maybe it's to do with fear of rates rising so much that it's, you know, the residential mortgages that tend to get squeezed the most in that situation. So there, but to your point, there is a little more leverage on a lower rate for that for those type of properties at the moment.
Sure. Thank you. Ryan, I've got a question for you.
Oh, yes. Hello.
Yeah, Ryan, I've got a question in terms of density.
Yeah.
And there's certain areas, Richmond, North Vancouver, and you already alluded to Vancouver, but those people who actually have homes, have land, do you feel that more and more districts, more and more cities are going to allow them to be more creative with the land usage that they have in terms of putting like row homes on it, even though it's just, you know, maybe a 10,000 square foot lot, but all of a sudden they're going to approve like, you know, row homes or a duplex with 4 units. Have you heard anything about this? And if so, in what areas?
Yeah, like so the Vancouver was a pretty big milestone. I mean, so now if you have basically everybody in Vancouver is approved for a multiplex as long as you meet certain criteria. So if you have a 6,000 square foot lot, you can do up to 6 units, although one has to be below market housing. If you have a standard lot, you can do up to 4 units. So I think, yeah, they will have to do it in the other areas. There's just not enough of the right product. So you're going to have to do it across the board because a single detached home just doesn't work for most people. It's not a good missing middle option for families that can't afford a regular detached house. I haven't heard too much about other areas yet, but I know with Vancouver doing this, it most likely the other areas will as well.
Got it. And then in terms of you know, upgrading from let's say a condo or townhouse up to the huge jump to a house, would you say that now is actually not a bad time to do that because the markets have calmed down and we saw the numbers of how single detached houses are probably the most balanced of the markets right now? Do you think that if they could afford it, it would be a good time to make the jump?
Yeah, I think so overall, because I mean, when we had these multiple offer scenarios like the last few years, in some cases people were bidding, 100,000 over, 150,000 over. So I mean, even though the rates are higher, I think you have more an advantage on negotiation now because you're not competing against as many people. And in a lot of cases now, like on our listings, you're not competing at all, right? So if a seller has been on the market for a couple months and all of a sudden they just get one, reasonable offer, I think you have a better foot to kind of stand on. Yeah.
Sure. Okay. All right. Well, I think our time is up for this quarterly report. Thank you everybody for joining us, and thank you Ryan and Dara for all of your great information. You've got our contact information here, and we will plan on keeping you abreast of this information as our dedication to our clients. But you guys have a great rest of the week and happy Thanksgiving to you.
Happy Thanksgiving. Thank you.
Yeah.